Okay, so currently Sage, we're teetering between bull and bull neutral, and that just goes back to our stance being at about 60%. We're not quite both feet in the water just because of, like I said before, all those reasons I cited, the market kind of teetering. And if it were to pull in, if we were to liquidate some more positions, just think that this X right here could, you could find yourself more in a bull neutral stance. But we're not anywhere close to being in a bearish stance. We're just teetering on the edge between bull and bull neutral. On a volatility standpoint, again, just to let you know, this is at the end of the second quarter. So this is as of June 30th, 31st, the end of June. Volatility, you can see we've actually done quite well. We're 3.4% versus the market is 4.1%. So yeah, we did peel our exposure back in April just because we saw these things kind of coming before the May top. But we'd rather be more cautious and peel back our exposure than to try to pick the turn. Sage is really designed to capture the wave and not pinpoint the turn. And we're definitely doing that. Like I said, the volatility is there. Return-wise, year-to-date, S&P was 12.6. We were 11. Going down into, let me flip the page. Okay. This chart up here just shows you where we're at from a defensive cyclical standpoint. Down here you've got defensive area, over here you got cyclical, and this circle here is us. S&P is right in the middle. We're defensive. A lot of that has to do with not only our 60% weighting, but also we do still have a 16% position in healthcare, which is naturally going to be defensive because of the pharmaceuticals. And it just so happened that it was a huge ripper this year, so it's done quite well for us, and we're still long full exposure in that. Going down further, breaking down what the portfolio still has, we have, this is actually, the cash is a little bit less now. We put another position on since this quarterly was put out, but I'll talk about that in a second. You can see the 16% exposure in healthcare right here. Still have a 10% core in the spiders, nothing wrong with the S&P. It would take a lot, like I said, it's going to take a lot more of this market deteriorating for us to shift into a bearish stance before we would, consider putting some type of an inverse spider hedge. So that's still on. The KRE, I don't know if in the last call if we talked about that or not, but we were noticing the regional banking sector was doing quite well technically, and the refinancing boom has really propelled this industry group. Has done really well for it. So since we've owned it, we're up about 12% in that position alone. That was put on over a month ago.
Okay. Yeah, you put it on. Was it at the end of last month?
Yeah, it was actually. It's funny. We had the call, and then I saw it moving. I'm like, Kev, we got to get on this thing. And we had been watching it for a couple weeks, and it just so happened that it was the day of the call after we had the call that we put the regional banking on. So.
Okay.
So yeah, we've been in it for a month, and it's a 10% position. We're up 12% on it. So, like I said, the refinancing boom has really helped out a lot with that.
What's your thought process is moving forward, considering the data that's come out on refis over the last couple of weeks?
You mean due to the fact that the rates, the 10 years increasing and the bond?
Oh yeah.
Is that what you mean?
We looked at the data on the refis and how much they've dropped in the last month, and it's.
Yeah.
I mean, it's unbelievable how much they've dropped.
Yeah.
It's been about an 80% reduction.
Yeah, exactly.
Yeah, I think. I think in the short term, that was quite a move off the bottom, and you had some investors, jumping after those low rates. And yeah, I think with the increasing rate, you're going to see it cool down. But this is just my opinion, but I think it's no more than a knee jerk. I think we would see it technically in the banking. We would see this thing really start to fall apart, and even today, this thing's up. The market is a little bit underneath par. You're basically flat, and this thing's up 0.5% today, and you're still seeing accumulation on the investor standpoint. So from a technical standpoint, accumulation, there's still institutions that want to be long this sector. So until we start to see that wane and this technically starts to break down, it's pretty much this whole just stay the path, stay the course, and try to take into account what the numbers are saying, but not fully rely on them. Finishing the pie chart here, we still have our 8% exposure in consumer discretion. Now, if we were to see, again, like I was saying, a deterioration from here in the S&P and further weakening, typically your consumer discretion is one of your first sectors to get hit. So this would be a candidate for liquidation if this market were to break down. Lastly, we got a 5% position in internet still doing well, and then we've got a 4% industry group exposure into medical devices. The one thing that has changed on this chart is we have started to get some exposure into oil. We're noticing that I'm going to pull up my charting software here a second. Kevin talked about this in the Joe a couple weeks ago. I actually mentioned it in the Weir last week. And on oil, you're seeing, you're seeing a very large move out of a 2-year wedge. So technically, there's a big move that is transpiring, and just very quickly it looks like that. And you can see this move, and the volume has come in right here. And whether that was caused by the crisis in Egypt or whatever it may be, you do have this pattern. You see some accumulation here. So based on the length of this pattern, I mean, this is a weekly chart and this is a 2-year. I mean, this thing could really have a move for the next year to 2 years, and we want to capitalize on that. But to chase oil, I mean, because you can see as it went out of this wedge, it kind of went straight up and didn't really give you a chance to buy it. So we're right now, we want to get exposure in the commodity itself, but we're waiting for this thing to kind of pull into some more reasonable levels around 100, which is likely to do because there's a resistance at 110. But that's a little granular. That's kind of the technical picture of it. We kind of got a head start with the AMJ. AMJ is it's a master limited partnership ETF, so it's mostly pipeline companies that's taking advantage of the shale and natural gas boom in the U.S. And this was technically was in a position where we could grab it with low risk. It's fundamentally it's got all the metrics for a multi-year growth, and so our thought was we could accumulate, kind of diversify within the oil and grab the pipeline. So we grabbed a 7.5% position in the AMJ. And then we're leaving another 7.5% open for when oil does kind of retest those lower levels near 100.